72 hours to decide this rally as mega cap earnings, the Fed decision, and potential government shutdown hang over this market. We'll discuss and debate with the investment committee. And joining me for the hour today, Joe Terranova, Stephanie Link, Shannon Sakosha, and Jason Snipe. We will go to the markets. The Dow is red, as you see. Everything else, though, is green, led by the NASDAQ as we get ever closer to those mega cap earnings that will begin tomorrow. The S&P hitting a fresh all-time high today. Gold and especially silver are reversing. Silver was down 5% earlier. We should note that every day because the moves there have been just astounding. And it is down near 7%. You have another tariff threat from the president. You have the Fed decision tomorrow. You've got Microsoft, Meta, and Tesla tomorrow as well. Apple on Thursday. And then the possibility of that shutdown coming on Friday. What's on your mind as you watch these markets today?
Well, there goes the broadening narrative. The S&P equal weight is actually down on the day. So we're back to the environment in which it's the mega caps, it's semiconductors, it's Lam Research, it's KLA Corp, it's Applied Materials making new 52-week highs. It is Apple making a nice recovery, Microsoft making a nice recovery. So once again, it's all about tech. And you're right, this is a critical week. And over the next 10 days, we're not just going to hear this week, but we're also going to hear next week from Alphabet and from Amazon. And the key is the spending. The spending is the key. And the spending has never really been the question. What really is the question is when the return.
Overspending.
No. It's when does the return on spending actually happen? If you think about it, the operating cash flow for Amazon, they spend 90% of that operating cash flow on building out data centers in AWS. The return on that spending, that's really the question as you begin to look forward. We're going to hear from all of these companies over the next 10 days about it.
What's interesting, Steph, is that many of these names are running into the prints, which does something to the bar. Maybe it raises it. I'm not sure because the stocks hadn't performed all that well going into the numbers. However, if you look at the one-week performance from many of these, Meta is up 11% over 1 week. You own that. NVIDIA's up 6.5%. Apple's up 5%. This is one of the few periods, really recently, where you can look over any kind of short period of time and say, wow, they're all up, because they haven't been trading all together as a monolith. But they have over the last week, trying to potentially anticipate what I think the street thinks is going to be a good reporting from these companies.
I think the reports are all going to be good, but to your point on the performance of these stocks, yes, they've had a good week or two, but they are all, except Google, they are all down from their highs. Meta is still down 15% from its highs. Microsoft down 12%, Apple down 10%. I actually like the setup of that when they're down, and yet they are starting to see a recovery. I do think that Joe is right about the spend. I think the spend is going higher, but to me, the most important thing is free cash flow after the spend. And all of these companies are going to still have considerable free cash flow. So Meta is going to have $16 billion this year. Amazon is going to have $41 billion in free cash flow this year. Microsoft at $77 billion, et cetera, et cetera. So they're all going to still have free cash flow and flexibility to continue to invest as they should, given the AI revolution. As a whole, earnings are running at about 9% so far.
They are. That's ahead of expectations.
And that is ahead, and I actually think you're on track to do something like 12, 13%. There are some aggressive targets, Scott, out there of 16, 17%. I'm not there. I'm in 12, 13 in a 3.5%, 4% GDP world, and it's not just revenues, it's not just earnings, it's not just revenues, it's also margins, which I pay very close attention to.
Yeah.
And I think the economic data still is very supportive of all of this, and so you want to pick your spots. I don't think it's just going to be Mag 7 that take over. I think I can name a whole bunch of companies that reported in the past week that are down because earnings is stupid season.
No, I'm glad you raised that point because I was literally going to go there next. Yeah. That Wolf points out today what they call punishing price action to start earnings season. That even very solid results, these are their words, the share prices of companies beating on the top and the bottom lines have witnessed negative relative price action after reporting. They do not think it's sustainable, though. They expect double beats to exhibit positive price action as more companies report. It is interesting, though, to see good reports not being greeted well on Wall Street, and that leads to maybe some trepidation heading into these numbers over the next couple of days.
Well, there's the potential that this is just a sort of re-rating in terms of valuation that investors are looking at. But I would agree with Wolf in that paradigm cannot persist in our view. And so we have 81% of companies that have beat on earnings so far for the S&P 500. That's a pretty darn good number. And I think what you're doing is you're looking at these earnings releases that are likely to come in the next few days. And Scott, there's really no reason that given the broad strength, there's no reason for the Mag 7 to upset that trend. I mean, there's absolutely no reason that they cannot continue to grow their earnings in this type of environment. I think more importantly, though, Scott, there's some of these exogenous weights on the market right now. There's some concern about a potential shutdown. There's concern about what's happening with the Fed and will they continue to be accommodative. And one could say that as we get further into earnings season, you're going to see companies in, for instance, in consumer. I actually think that's going to be really important from an inflection point perspective. The consumer confidence data today was pretty weak. And so I would say if we can get through earnings for tech and then we have consumer on the horizon, I actually think that that's where you could start to see some of this double beat really start to catalyze a stronger move, to Joe's point earlier, in the broadening direction.
I'll just come back to you for a moment when you say, the question is not about the mega cap companies growing their earnings. It's not about that at all. It's about the growth rate.
Right.
People aren't worried about them growing their earnings. It's can you still grow your earnings at 50% or whatever that you had been to justify the appreciation of the stock and the multiple in these names. Yeah. That is what investors are grappling with as they look at the breakdown of the market, the broadening of it. Questions about, well, can tech still lead the way if those growth rates are slowing in any way whatsoever?
That's what we've been talking about, those valuations potentially being vulnerable for 6 or 7 quarters now, Scott, and yet we continue to see the growth. And I think to Stephanie's point, if you look at the narrative from these hyperscalers in particular, they are still willing to put forth the spending. They are still willing to meet what they think is still an undersupply, to Joe's point earlier, of this infrastructure. And so therefore, there's no reason to think that without any evidence of a dissipation of demand, which we don't see for AI, there's no reason to think that they can't continue to grow them. Most importantly, though, however, that delta is compressing. We're seeing the rest of the market grow their earnings, and therefore that delta compressing, I think, is going to be representative of that broader lens.
I got a developing story I'm going to get to in just a second because it's interesting, and I know you're going to want to hear about it, but I want to hear from you first.
Yeah.
As we said, the stack this week is the earnings, the Fed decision. Yep. I'm not expected to do anything as the Fed, but the questions to Chair Powell in the conference, the news conference, are going to be interesting, not only on Fed direction, but Fed investigation. So, that's going to be hanging over the market a little bit.
Sure.
We're looking towards Friday. Are we going to get another government shutdown? Market's sort of yawning a bit at that.
Yep.
What's on your top of your mind?
Yeah, no, I think all those pieces loom large, but I think for me it's definitely mega cap tech, right? We're hearing from Apple, Meta, Microsoft, and Tesla this week. I think to Joe's point, CapEx is a very important piece for me. I mean, $400 billion of spend in 2025, $500 billion plus planned on spending in 2026, and north of $600 in 2027. I think the return on this CapEx is going to be critical. Free cash flow, again, what Steph mentioned, I think is important as well. Margin expansion. What does that story look like? We need to see these companies continue to grow. I think the other concern for me a little bit last year was the debt market, right? From Meta, Amazon, the rest, Oracle as well, and starting to dip into the debt market to raise funds to continue to build and the innovation that we're seeing. So I think that's what's really on my mind. We'll see from many of these names. I think Amazon will be solid. I think Microsoft hasn't traded well. It'll be interesting to see what goes on with Azure, and also I think there's some interesting thoughts playing out in the market in terms of Microsoft having a legacy product, and what does the real integration story look like? I think it's been a story of AI first names really starting to continuing to perform. So I'm really anxious to see what Microsoft reports.